The Federal Reserve is going to be forced to end quantitative tightening in 2025. In other words, this slow decline of their balance sheet that we have seen ever since it peaked in May of 2022 will end, and their balance sheet may even start increasing again. So in this video, I'm going to show you a few things. Number one, what is the impact on the markets and the economy when the Fed makes changes to its balance sheet, either by growing it or shrinking it? And number two, most importantly, what is the impact on the market and the economy going to be this year when they end quantitative tightening? So first, how did we get here? Let's start in 2020. We all know that was the year in which the federal government and the Federal Reserve embarked on a brand new experiment to see what would happen when they printed a bunch of money and just handed it out to people, simultaneously locking down the economy. Spoiler alert, it caused a lot of asset price inflation and then a lot of inflation in goods and services. But the process by which that happens is a little bit more nuanced. Step one, the US government said, hey, we're going to be borrowing a couple $1 trillion. So they go to the only people they're allowed to borrow money from, which is individuals in the free market, namely financial institutions. So the government goes to the banks and says, hey, give me all you got. I want to borrow a few trillion. Now the banks say, well, we have some cash, we just don't have a lot of it. So we'll loan you the cash that we do have. And now we get that IOU from you. You owe us cash back. But the government says, no, we need to borrow a lot more. So the bank says, well, let's see what we can do. The bank then turns to the Federal Reserve and says, hey, Federal Reserve, would you like to own this debt instead of us? Then the Federal Reserve says, sure, I'm just going to print some money into existence, buy that debt from you. So now, since I'm buying the IOU from you, the federal government will owe us, the Federal Reserve, that cash in the future, and you now have fresh cash you can go do whatever you want with. So the bank says, great. The bank then turns around, takes that fresh, newly printed cash, loans it to the US government again, gets a new IOU, turns back to the Fed, sells the IOU to the Fed, and just repeats this process over and over again. Now, if it sounds to you like the bank is operating as a middleman between the Federal Reserve printing money, loaning that cash to the federal government, you'd be right. And the reason why the banks are operating as the middleman is because it's actually illegal for the Federal Reserve to directly loan cash to the US government. It's called debt monetization. And the reason why it's illegal is to prevent the very thing that's happening right now, quantitative easing, and the Federal Reserve owning a bunch of federal government debt. But they found a loophole in which they used the banks as the middleman, and so now everything is fine and dandy. Except that it's not, because it immediately caused a problem. After the federal government borrowed the trillions of dollars, what did they do with it? Well, they spent it. So that cash goes out into the economy, gets spent from one person's bank account to another bank account, which means all of the banking system gets flooded with trillions of dollars of new cash. Why is that a problem? Because banks can't just accept cash and not do anything. When you make a deposit at a bank, that is your asset and the bank's liability. They owe you that cash, just as it would be a liability for you if you swiped your credit card and now you owe the credit card company dollars. It is a liability for the bank if they take cash from you and owe that cash back to you, which means if they don't do anything with that cash, they go bankrupt. They've got to make money with it. And so what do? They have to turn around and buy some assets. Usually that's going to be short-term government debt. The problem is the Federal Reserve just got done buying up all of that short-term government debt out of the market. So the banks receive all of this cash, deposits, liabilities, they go to get some collateral, and there's none to be found. And so the Federal Reserve comes up with a great idea where they say, hey, you can just borrow that collateral from us. And if this is getting confusing, don't worry, it is confusing, but to simplify, we're going to look at a chart of where all of this money went. Right now, you're looking at the reverse repo facility, and this is where banks placed all of their cash that they got in deposits that they needed to get collateral for. They used the reverse repo facility at the Fed to get that collateral, and that's why this facility peaked out in its usage at around $2.3 trillion. Now, the Fed was able to get banks to do this by offering banks a sweet reward by parking their cash there at the Fed in this reverse repo facility. This meant that banks were not going to be taking that cash and loaning it out to the government. They weren't going to be loaning it out for productive use to private citizens. They're just going to be getting a sweet interest rate, which was 5 basis points above the lower end of the federal funds rate, just to get their collateral for free from the Federal Reserve. The banking system was making hundreds and hundreds of billions of dollars just to park their cash with the Fed. And by the way, guys, with Trump's inauguration just weeks away, I don't have to tell you that things could get absolutely wild in 2025. Trump's administration has already promised to cut government spending in half, issue blanket tariffs on China, even delete entire federal agencies. And while I don't want to get too political here, I can promise you this. America is about to see a tremendous amount of change. That's why on January 23rd at 7 p.m. Eastern Time, I'm hosting a free asymmetric trading masterclass live on Zoom. I'm going to show you the best way I know to profit from a changing paradigm, the asymmetric trade. On this call, we're going to cover things like why I believe 2025 could be the year of the asymmetric trade, a simple 3-step protocol I have used to spot these trades, and details on a few sectors I think are poised for asymmetric trades right now. Look, in the past, these types of trades have handed out some of the biggest returns in the market, and I've personally used them to take home some big gains in my own account over the last couple of years. And now, with a massive political change about to hit the markets, these trades could present bigger opportunities than ever before. If you're interested in learning how they work, simply click on the link in the description below and enter your email to sign up. Again, attendance is completely free, but spots are limited. In fact, the last time I hosted one of these masterclasses, we had more people register for the event than I could fit on the Zoom call. So if you're interested, make sure you sign up now and I'll see you there. However, this is a chart of the interest rate that the US government was paying every time it borrowed debt that matured in under 1 year. And you can see for a long time, it was around this 5.6%, then 5.4%, and only recently has it started to drop down around the 4.2% level. Now, when you loan money to the federal government, it is mostly risk-free, but there's still a chance that they could default, whether that is from political incompetence or a gridlock in Congress or somebody just declaring, hey, we're not going to pay back the debt. There is some level of risk there. However, if you're a bank and you throw your cash in the reverse repo facility, you are literally lending that cash to the money printer itself. Politically independent, no need for votes, no need for political approval. You're lending that money directly to the money printer. It is as close to risk-free as you can get, which means if the US government wants to borrow money, they're going to have to borrow it at a rate that is at least a little bit higher than what you can get risk-free from the Fed. And so for a couple years, that's what happened. The federal government, if it wanted to borrow money for under a year at a time, it would have to pay a little bit extra to be able to get some of that cash. And slowly but surely, that cash drained out of the reverse repo facility and was loaned to the US government in the form of T-bills instead. But here's the thing. The reverse repo facility is done now. It is ended. That extra reward that the Federal Reserve was paying on balances in the reverse repo facility, that is gone. They are no longer paying that premium. As a result, the reverse repo facility will be used temporarily at quarter end and at year end for short-term little spikes in cash management across the banking system, and that's it. There will no longer be any excess cash in the reverse repo facility. It has all been sucked out and it has all been loaned to the US government through T-bills. This is a major liquidity problem because this is the main source of borrowing the government has been relying on for the past 2 years or so. In fact, about $7 trillion worth of the national debt is in T-bills right now, which means over the year of 2025, about 30% of the national debt is going to mature, which means they have to pay it back. And if you haven't noticed lately, the federal government doesn't run surpluses. The only way they pay their bills is by borrowing more. And so when they have debt that matures and comes due, the only way they pay that is by borrowing that money. But no more are there trillions of dollars kept in the reverse repo facility, which means the federal government can't just pay a small premium and be able to suck extra cash out of the reverse repo facility. So where is this money coming from? Well, number one, this is coming from the Treasury General account. You can think of this account like the US government's checking account. Right now, this account has about $767 billion in it, which sounds like a lot, but at the rate the US government spends, this isn't actually that much. And so if the government can't borrow enough from the financial system, then it's going to have to start drawing down on its reserves in the Treasury General account. But this can only last so long. And this is where the Federal Reserve's balance sheet comes in. As a recap, when the Federal Reserve's balance sheet is moving up, it is because they are printing money into existence, using that money to buy assets from financial institutions. Those financial institutions can then turn around and take that cash and do whatever they want with it. And most often they use that cash and loan it out to somebody else. However, when the Federal Reserve's balance sheet is declining, they are doing the opposite. As it has been doing since May of 2022, the Federal Reserve's balance sheet is declining. Now remember, the Fed's balance sheet is made up of debt, and that debt periodically gets paid back. So applying a little bit of logic here, we know that when the Federal Reserve's balance sheet is climbing, it's because they're printing money to buy assets. When it's declining, it's because they're accepting dollars back from from debt that is getting paid off, and those dollars are being actively destroyed. In other words, it's not like you or I. If you have somebody who owes you money, they pay you the money, and now you take that cash and do whatever you want with. That's not how the Federal Reserve works. When they loan money, it's loaned into existence. When money gets paid back to them, it ceases to exist. That money leaves the financial system, leaves the economy. It doesn't exist anymore. It's gone, which means when the Federal Reserve's balance sheet is declining, it is actively draining liquidity from the market. And no, the government doesn't stop borrowing during this time. It's continuing to borrow. Meanwhile, their main source of borrowing over the last 2 years has completely evaporated, and they're going to have to roll over almost a third of the national debt this year. And the Federal Reserve is still allowing its balance sheet to decline. Now, I need to be clear. If I were placed in charge and I were making decisions about what would be best for the economy and healthiest long term, we would get rid of the Federal Reserve's balance sheet. Heck, we'd get rid of the Federal Reserve. I'm not making a case for what I think should happen here. I'm making a case for what is going to happen this year. So what do we think will happen when the federal government has to continue to borrow? The place where they are borrowing from is drained, and the Federal Reserve is still pulling liquidity out of the market. Well, we're going to see something like this happen. The Federal Reserve's balance sheet is going to start moving sideways. In other words, they were going to end quantitative tightening. Now, the way that they do this is not just by stopping doing anything. In fact, even while their balance sheet is declining, it's not as if they're just allowing the debt to get paid off. The debt gets paid off to them in random intervals, but they make sure that the pace at which their balance sheet declines is very steady. So they're constantly selling assets, buying assets, making sure their balance sheet composition stays what they want it to be, and just letting a slow bleed off of their balance sheet occur. This means that when they stop QT and their balance sheet starts moving sideways, they will be even more active. Anytime debt gets paid off to them, they will take new dollars and lend them right back out, making sure they're not sucking any liquidity out of the market or pumping excess liquidity into the market. Now, they do have a range of assets that they hold, from mortgage-backed securities to T-bills all the way to 30-year bonds. And so depending on the way that the federal government wants to do their borrowing, the Federal Reserve can shift the composition of their balance sheet, meaning they can sell some 30-year bonds, they can buy some more T-bills, or opposite, in order to make sure that the federal government has their financing needs met. But the $7 trillion of debt that's getting rolled over this year, not to mention any additional borrowing from additional deficits this year, it's not just going to come from nowhere. The excess reserves in the system are gone, the reverse repo facility is drained, and yet the borrowing needs are only getting higher, which means this year the Federal Reserve will be forced to either stop decreasing its balance sheet, ending QT, or it might even resume QE yet again. This is all part of the long-term debt cycle I've been warning you guys about for years now, which is that we have a longer time period of inflation as the government borrows and spends more, driving prices up. The Federal Reserve, they're going to monetize all that, enable it, but interest rates and prices for you and I are going to continue to climb. This is an inflationary deleveraging. They're using the exact playbook of the 1940s through the 1980s. If you'd like to gain access to my Century portfolio completely free, to see my 100-year stocks that should survive and thrive well past this phase of the long-term debt cycle, go ahead and click on the link in the description below. As always, thank you so much for watching. Have a great day.